In this video, we will talk about basic stock fundamentals. We will cover 5 basic areas that characterize a stock. But before that, don't confuse fundamental analysis of a company with stock fundamentals. Fundamental analysis looks at a company's ability to generate revenue, profit growth year over year, and profit margins, etc. Stock fundamentals are market caps, shares information such as shares outstanding, float, and institutional ownership, so on and so forth. The 5 areas we will go over are shares outstanding, float, market cap, insider and institutional ownership, and stock split. Shares outstanding is a company's stock currently held by all of its shareholders, including shares held by institutional investors and restricted shares owned by the company's officers and insiders. Float is a number of shares available for trading for a particular stock. A stock with a float of 10 to 20 million shares or less is considered a low float stock. A low float stock is generally more volatile. Because with fewer shares available to trade, it may be harder to find a buyer or seller, which means potentially larger spreads and lower volume. There is another type of float that you'll see in stock fundamentals. Short float is the percentage of shares in the market that are shorted to the float of the stock. If you haven't checked out the last video on short selling, I got you. The link is in the description. Anyway, let's say the float is 1,000 shares, and the short float is 20%. That means there are 200 shares being shorted. Remember, the float is different from shares outstanding. Shares outstanding can be 10,000 shares, but if the float is 1,000 shares and the short float is 10%, the shares being shorted are 100 shares, not 1,000 shares. When a company's short interest is high, usually greater than 40%, it means a good amount of investors are expecting the stock to go down in price and are looking to profit from the drop. So it is important to look at the short float. Because with high short float or short interest, it implies negative market sentiment. The short interest can exceed the float and exceed 100%, like GameStop. We also have a video with a link in the description if you're interested in how the short float can exceed 100%. The next area is market capitalization, or market cap. Market cap is the total dollar value of a company's shares outstanding, or how much the company is worth. The formula is the stock price multiplied by the shares outstanding. The market uses this figure to quantify the size of a company rather than the sales or total assets. Generally, there are 3 tiers of market caps: large, mid, and small. Large cap is 10 billion or more. Mid cap is 2 billion to 10 billion, and small cap is 300 million to 2 billion. The smaller the market cap, the more price movement of that stock, so more opportunities to make money, but also higher risk. And for larger cap companies, they are less rewarding to invest, but they are also less risky. Next are insider and institutional ownerships. Insiders are a company's officers, directors, relatives, shareholders who own more than 5% of the shares outstanding, or anyone else with access to key company information before it's made available to the public. Usually, insiders need to file a report with the SEC before they can acquire or dispose of the stocks they are insiders to. Because you can interpret that if an insider is buying more, that means more upside for the company's future, and vice versa. Institutional ownership is the amount of outstanding shares owned by large funds or entities that manage funds on behalf of others. Stocks with a big institutional ownership usually have good market sentiment. Institutions generally have a professional team of analysts who perform detailed and extensive financial research before acquiring a large block of a company's stock. Lastly, we are going to talk about stock splits. A stock split is when a company divides its existing share into multiple shares. For example, a 2-to-1 split of a $10 share with 100 shares outstanding will become $5 a share with 200 shares outstanding. So you can see, a stock split doesn't change the market cap or the valuation of a company. Companies split so they can create more liquidity. Again, a stock split does not add real value to a company. A stock can also reverse split. Reverse split is a company decreasing the shares outstanding and increasing the share price. For example, a 1-for-10 reverse split means that a company that has 1,000 shares outstanding, each worth $1, is now 100 shares outstanding, each worth $10. Like a regular stock split, a reverse split does not change the market value of a company. A company that would do this is if the share price had dropped to a point at which it runs the risk of being delisted from an exchange. Another reason could be that a stock with a higher price is perceived as more valuable. Just a general rule of thumb. Usually, a reverse split from a company is not a good sign for the company. If you want more content like this, be sure to hit that like and subscribe.